Most traders lose money because they follow noise. This strategy, it follows structure, clear, tested, and consistent. In this video, we'll break down a complete trend-following system built on three core elements: the 200 EMA, RSI momentum, and engulfing candles. You'll get the exact entry rules, see real backtest results, and understand why it works across different markets and timeframes. If you're serious about leveling up your trading, stay with us. We'll guide you through every step and share key tips to help you trade with more confidence and precision. First, it's important to point out that many traders often make the mistake of trying to catch the absolute bottom or top in a trend, hoping to perfectly time the reversal. While it sounds great to pinpoint the exact moment a trend reverses and ride the move to massive profits, the reality is that finding that precise point is extremely unlikely most of the time. If you've watched our videos before, you know we're all about probability and success rates. We're firm believers in trading with the chart, not against it. What we mean is, we only take trades when the chart shows a clear uptrend. With that in mind, let's dive into this strategy. Before applying any strategy, it's crucial to highlight the importance of preparation and market context. Francis Hunt, known for his technical and intermarket approach, brings a perspective that reinforces this mindset.
You start putting 91% into your chart analysis and looking at it across intra-markets. Say you're looking at buying gold. How's the gold doing relative to the dollar? Is it the dollar? Have you looked at gold versus the euro? You're doing all this intra-market analysis, looking at all the patterns, drawing every pattern in the run-up, seeing where all the key levels are, seeing how it's interacted with all the key round numbers, looking at the volume, where's the volume been building up, looking at the volatility, seeing if your setup is potentially a downside setup and comparing it with other similars that you've taken. You're doing some of these things that I've only some of what I do before a trade. You do that 91%, you're going to be part of the 9% on balance most occasions. What actually happens is people spend most of the time being in the trade and hitting the trade and trading in and out, and very little of that is actually in the pre-trade preparation. And it's like anything, you know. People used to say about Kevin Peterson for his batting, you put an immense amount of time in the nets. And then they'd say, oh, he's a good batsman, look at him swinging the bat. And they'd forget about how much work has gone into it, you know, beforehand. You see him playing in the test match. That's a fraction of what he's been doing on the batting front.
That's why focusing on preparation and market alignment is essential. It's not just about taking trades, it's about earning the right to take them. Let's move on to the next part of the strategy. Now, let's get right into it with rule number 1, and arguably the most important rule. We'll only trade with the trend. At least, that's the case for this strategy. So, you might be wondering, how do I know if a chart is in an uptrend or a downtrend? There are several ways to identify market trends, ranging from price action analysis to advanced technical indicators. However, one of the quickest and most widely used methods is through moving averages. To apply this, head over to TradingView, click on the Indicators tab, and type in EMA to add the exponential moving average to your chart. Once it's added, open the settings for the indicator and set the length to 200, creating a 200-period moving average. We like to change the line to red for better visibility, but that's entirely optional. For this strategy, the first and most critical rule is that we will only enter trades when the chart is in an uptrend. Specifically, this means we will only take trades when the price is above the 200-period EMA. If the price is below the 200-period line, we simply don't trade. Remember, trading with the trend is non-negotiable for this strategy. In this video, we'll focus on how to trade long positions using this strategy. If you're looking to trade short, the concept is just as straightforward. Simply apply the rules in reverse. Now that we've covered rule number 1, let's move on to the next rule that must be met before entering a trade. Rule number 2 involves using the RSI indicator, but with a unique twist. Here's how to set it up. Go to the Indicators tab and type in RSI divergence. Make sure to select this specific one. Once it's added, we'll adjust the settings for better clarity. Open the settings, then uncheck the bottom 3 checkboxes to clean up the chart. Next, navigate to the middle line tab, change the color to white, and make it a solid line for better visibility. While the traditional RSI is often used to determine if the market is overbought or oversold, we'll use it differently in this strategy, to measure momentum in the market. This brings us to rule number 2. Only enter a trade if the RSI line is above the middle white line. If all other conditions are met but the RSI is below the line, we don't enter the trade. An added bonus of this customized RSI indicator is that it highlights divergences, giving you an extra edge in spotting potential reversals. If you're not familiar with divergences, here's a simple explanation without getting too technical. Divergence happens when the price moves in one direction while the indicator moves in the opposite direction. For example, if the chart is making higher highs, but the RSI is making lower highs, that's a divergence. The great thing about this customized RSI indicator is that it automatically highlights when bullish divergence occurs, making it easy to spot potential reversal points. That said, a quick heads up. This RSI indicator can occasionally miss some divergences, so it's worth double checking manually now and then, just something to keep in mind as you apply it. Still, it's a powerful tool overall. Spotting bullish divergence isn't a required condition for this strategy, but when it shows up, it's a strong confirmation that can add confidence to your setup. When all the other rules are in place, let's move on to rule number 3. If you've watched our previous videos, you know we have a strong preference for momentum candles. They're a fantastic way to identify the start of a trend. The specific momentum candle we're focusing on is called an engulfing candle. Simply put, an engulfing candle is one that completely engulfs the previous candle. A bullish engulfing candle opens at or below the previous candle's close. The length of the bullish candle's body engulfs the previous red candle, and it closes above the previous candle's open. This pattern is a powerful signal for spotting the beginning of an uptrend. Rather than manually scanning for this candle and watching the chart all day, we'll let an indicator handle it for us. Go to the Indicators tab and type in Engulfing Candle. Select this one right here. After adding it, you'll notice a series of red and green arrows on your chart. Since we're focusing on long trades in this example, you can disregard the red arrows. All the green arrows point out bullish engulfing candles. Finally, let's move on to rule number 3. We will only enter a trade if we see a green arrow. Now let's break down what a successful trade setup looks like. First, confirm that the price is above the 200 period line, indicating the chart is in an uptrend. So far, so good. Next, check that the RSI line is above the 50 mark, and in this case, it is. Great, we're still on track. Seeing a bullish divergence is not a requirement, but if it's there, it's an extra confirmation, a +1, that makes the trade even more bullish. Finally, look for a green arrow, which indicates a bullish engulfing candle. Important note, we will only enter the trade after the green arrow candle closes. I repeat, do not enter until the candle with the green arrow has fully closed. Keep in mind, a candle might show a green arrow while it's still forming, but it can change before it closes, ultimately not qualifying as an engulfing candle. That's why we wait for the candle to close before taking any action. Once the candle closes and there's a green arrow, we enter the trade. For this strategy, we'll set a stop loss at twice the length of the entry candle. Then we'll set our take profit at a 2-to-1 ratio relative to the stop loss. It's that straightforward. And just like that, the price hits our target. If you're someone who tends to get anxious, exits trades too early, or second guesses your decisions, here's a valuable tip. Set your take profit, set your stop loss, step away from the screen, and let the strategy do its job. Trust the process and let it work for you. This approach helps you avoid emotional trading, like selling too early or even worse, getting greedy and moving your take profit. It instills discipline and keeps you focused on the strategy. It's also important to understand that you won't be trading every day with this strategy. Since we're only trading with the trend, the chart won't always be in a trending phase. There will be days when the market simply doesn't meet the criteria for a trade. And that's okay. The key is recognizing that this is part of the process. You'll only trade when the market aligns with your strategy, ensuring you're working with the market, not against it. Let's do one more example to tie it all together. First, we check if the price is above the 200 period line. That's our first confirmation, and in this case, it checks out. Next, we look at the RSI to make sure it's above the 50 line, and it is. So we're good there too. Now, we also spot a bullish divergence on the RSI. While this isn't a requirement, it's a great bonus and increases the chances of this being a winning trade. So far, everything's looking solid. Then, we notice a candle with a green arrow under it, which means it's a bullish engulfing candle. The key here is to wait for that candle to close before doing anything. Once it closes, we enter the trade. From here, it's straightforward. We set our stop loss to 2 times the length of the engulfing candle. We set our take profit to a 2-to-1 profit to risk ratio. And now, we simply wait. The price eventually moves up, hits our take profit target, and we exit the trade successfully. Easy to follow, right? That's the power of a well-structured strategy. Now, to wrap things up, let's go over a quick summary of the strategy we presented. First, identify the trend using the 200-period EMA. For long trades, the price must be above the EMA, indicating an uptrend. For short trades, the price must be below the EMA, signaling a downtrend. Next, check the RSI momentum. For longs, the RSI line must be above the midline. For shorts, it must be below the midline. This ensures you're trading with momentum in your favor. Then, look for a confirmation candle. For longs, find a bullish engulfing candle. For shorts, spot a bearish engulfing candle. This provides the final green light for entering the trade. Finally, apply proper risk management. Set your stop loss and take profit using a 2-to-1 risk-to-reward ratio and let the strategy play out. Stick to these steps consistently for high-probability setups in any market. In conclusion, this strategy shows how clear, disciplined rules can drive consistent trading results. By combining the 200-period EMA, RSI for momentum, and engulfing candle patterns, you're working with a trend-following system that applies across markets and timeframes. Patience and discipline are essential. This approach keeps you focused on high-probability setups, trading only when the market aligns with your rules. Trust the process, sharpen your execution, and let the strategy work without emotional interference. But even with a solid system, there's one more principle you can't ignore: independent thinking. Relying on opinions from forums or social media can quietly erode your edge. Alexander Elder explains why this is one of the most dangerous habits a trader can develop.
Math psychology of the market. The general human tendency is that we huddle under stress. What do you think? So is Tesla going up or is Tesla going down? Markets provide plenty of stress. And the tendency that we have, we look at what other people are saying. But the difference between the market and many other areas is that market is absolutely hostile. If you drive and accidentally swing into another lane, the guy who is driving behind you is going to honk at you, but he'll hit the brakes because accidents are expensive for both parties. In the markets, you swing into your own lane, somebody will take your door off of your car together with your arm. So asking other people what do I do is probably not the best idea in trading. One of the worst things that traders do, they put in a trade, and let's say the guy buys Tesla. He goes on the internet to see what other people are saying about Tesla. Well, is that part of your trading system? I mean, you decided to buy when the moving average is up and prices are near the lower channel line, whatever you decided. You exit when prices hit the opposite channel line, but the question is, does looking at the chat rooms figure in your plans somehow? So it's a very dangerous thing, looking at what other people say. What we do in Spike Trade is based on a book that shocked me years ago. There is a very good financial journalist here in New York. His name is James Surowiecki. He wrote a book called The Wisdom of Crowds. And I saw that title and I said, Wisdom of Crowds? I thought crowds were dumb. Well, it all depends on how crowds are organized. The intelligent crowd is the one where people take decisions independently. And then the people who run the group just kind of bring those decisions together. In Spike Trade, where people compete for the best pickers of the week, the site goes under embargo on Friday at 5 p.m. It's under embargo right now. It's going to open at 3 o'clock, at 3:15 on Sunday. So everybody submits a pick for the competition, not knowing what other people are submitting.
It's a powerful reminder. Your best trades don't come from the crowd. They come from clarity, preparation, and independent thinking. So if you're serious about building consistency, confidence, and control into your trading, the Psychology of Trading playlist is your next step. It's where the real work begins, the part no one sees but every pro relies on. Because in trading, what happens behind the scenes isn't just important. It's what makes the difference. I hope you enjoyed today's video. If you found the content helpful or engaging, please give it a like, as this helps the video reach more traders like you. And don't forget to subscribe to the channel and turn on notifications so you never miss our latest insights on the markets and practical trading strategies. Sharing this video with your friends or on your social networks can make a big difference and helps our community become stronger. Now, if you want to go even deeper and get access to exclusive content, early video releases, and extra tools to support your journey, consider becoming a member of the ComLucro Trader community right here on YouTube.